I just want to say, ever since I joined this class, my stocks have been up. So thank you. Thank you.
Who's that? Oh, sorry, I didn't see that. Whose stock is going up?
That was James.
James,
Good luck, James. That's good. Let's keep it like we don't want
you're
to.
doing something right. Keep up the good work.
All right. Okay. Very good. Very good. Excellent. Excellent. That's good. Yeah. You know what? I think in the end of the day, hopefully, it's more about getting more confidence in what you're doing. Start understanding the butter of all this, and and the more you get confidence in a good way, not in an arrogant way, especially when it comes to risk management and risk controls, then you start seeing some really potentially very important results coming out from your investment strategy. I don't like to claim that this is like a course to make money. It's not like that. So it's just to tell you fundamentally how to create investment strategies, how to make sure that they don't break, what are the risk management rules, and how to build a portfolio. And hopefully you will have enough tools and understanding in your hand that you can actually go ahead and do it yourself or at the firm where you are. Okay, so last time we spoke about random walks, yeah, and we said this is the topic of random walk, which we can model stock returns on that. And we described how a variable like xt is related to variable t minus 1, and of course this can go on, but now we're just focusing here on the first leg with a drift mu and a Brownian motion component, which kind of captures randomness. And that is, this Brownian component is described by what I call white noise epsilon, which has a identically and similar distribution. It's N01, where 0 is mean and 1 is the standard deviation. And then sigma here, in principle, is what I would call the standard deviation. It's a measure of volatility, which is going to be, and in general, it's going to be function of course, of the observation. So volatility can be function of the financial time series. And that's the kind of the most generic form that we talked about. We showed how actually you can draw that random walk, and Matt showed us last that time. Autocorrelation, how the autocorrelation starts very high when you have, immediate lags like day one or time one or time step 1, 2, 3, 4. And then when you start going to 200 and above, of course, it starts dying off down to 0 and all this. And then tweaks, it becomes negative, actually. So if you're trying to look at the autocorrelation between now and something that happened, 500 days ago, like 2 years, it could be completely negative. And then here we came to the meat of the matter, is that when we start relating that variable, that x of t, to the stock, and we said we're going to rate it to log of s of t because we expect stocks to be positive. And I think Dave kind of came to a very good answer last time when we said, okay, well, is there something missing in that equation? X of t has no dimension, has no unit, while S of t has a unit. It could be dollars, and well, there's a normalization inside that log, which is S of t divided by S of 0, the initial value of a stock. But for, abbreviation, we don't include it here all the time. But you need to understand in mind when I write x of t is equal log of s of t, I really mean here log of s of t divided by s of 0, which is the initial value. So then s of t over s of 0 has no dimension, and then you can take the log. You need to be very acute about this kind of conceptual understanding, because a lot of people make mistakes in these things. And believe me, professional academician, they make mistakes in that. It's just not, it doesn't require to be a genius to make a mistake in these things. And then we said, of course, x of t minus x of t minus 1, it's like the log of f of t over st minus 1. And that's almost like start looking like a stock return. Yeah, because stock return is what is the stock difference between now and, let's say, an hour ago or 10 minutes ago or a day ago, depending on the timestamp that you are at. Okay, so the first thing we learned is that random walk is very ideal to a stock behavior, and why? Because we compared this with the behavior of Amazon. It looks pretty much similar, huh? But random walks have different characteristics. Remember, The first random walk, which I would call the first form of a random walk, is a random walk in which this beta here is 1. Simple. And then you take x of t minus x of t minus 1. If you put it into this log s of t language, it's just the return of the stock. Simple. So in fact, the return of a stock satisfies a very simple first form of random walk, but with a caveat, with a constant drift mu and a constant sigma volatility or standard deviation. Now, when we go to the second weaker form of a random walk, all we are going to do is that the IID now becomes INID, which means identical but independent but not identical random walk, which means now that epsilon, remember before it was 0 and 1, that white noise, that one now is replaced by theta square t, where theta now, the volatility here or the standard deviation itself is a random walk. It has a 0 mean as it has a constant standard deviation. So that's the second form. The second form, therefore, is that now these random noises, they're not anymore constant. They don't have like what Marina said last time, it's a constant, but they have their own volatility. So that sometimes in the financial firm, they refer to as vol-of-vol. Yeah, you're going to remember vol-of-vol, the tail of a distribution. Yeah, it's a very important concept. So the volatility has its own volatility, and it's actually itself a random walk. Now, finally, the third and the weakest form of a random walk, this is when you start having a stochastic volatility model. And in this case, you have the full blast of sigma being function of the financial time series itself and the time t. Okay, we are not going to cover in this course here this one, i.e., we are not going to be dealing with stochastic volatility model. It's outside the scope, but remember that this is one component of complexity that you can add on your theory, on your model. And look, stochastic volatility model can have their own merit. Why? Because there are people out there who actually trade volatility. For them, volatility is actually an asset. And you can actually, how you can do that? We're going to come in a minute. So remember stochastic volatility model. So here's a stock price. I mean, look at Amazon, how random it looks like a random walk. It's beautiful. For me, don't underestimate the beauty and the depth of this discovery, by Wigner and by all those statistical economists. And this is also here, different prices of the same stocks at the close. So you can see it's very chaotic mention, very Brownian nature. And, it typically look as if they have that white noise. So isn't that funny that if you look at simplicity in nature, somehow stocks or assets have that behavior where they are almost standard Gaussian distribution in terms of the noise, and that noise is a white noise with 0 mean and etc. But that doesn't mean that this is the rule all the time. So be careful. That's word of notion. Here are the indices. You can see the Dow Jones versus the S&P 500 and the Russell 2000, all that. Same thing, very random, draw down, up, down, all that. So, okay. We come now to the next point, is standardization and normalization. I think we mentioned that before, that, if you look at this picture here, can someone tell me, well, does it make sense to actually try to transgress or regress the Dow Jones, which is at like 10,000 or 20 or 50,000, against maybe, S&P, which could be just a few thousands, or others? Does it make sense? James, tell me why.
You probably want to normalize it first, because you're not going to capture the relationship.
Exactly. Good. Okay, excellent point. So this is one important. You want to normalize that thing because you want to compare apples with oranges. So the first and very simple normalization is the z-score. You try to say, okay, well, let me tell what really matters when I'm comparing different time series is that time series which describes it as a deviation away from its mean. That's what the z-score. It's how many standard deviation is a time series away from its mean. That's the z-score. Good. So all of them will follow the same rule, and then we are going to see, in fact, this graph. So look at this now. This is the old graph before standardization, and now this is after standardization. So now we can regress Dow Jones against S&P. So now we can start building our models, yeah? And that's very, very important. While here, I believe me, I see a lot of people, they do that. They take the Dow Jones and they regress it against the S&P as raw meat. And I say, what is the matter with these guys? Yeah? And then they say, well, we have losses or making money. Actually, some of them, they claim they make money. I don't know how they do. Now, the second way to normalize is what I call the feature scaling, where you try to subtract the minimum from the time series. And usually this type of normalization, we use it in principal component analysis and vector machines, which will come later to it in the course. Okay, let's talk about two simple things and settle the score here. And a lot of people ask me this question, and I made a slide of it. What's the difference between nominal return and total return, and who uses what? Nominal return, simple. What's the value of the stock today versus the value of the stock one time step away? That could be a day away or 10 minutes away or a tick away, divided and normalized by that stock value minute away. That's what we call RT. And look at this relationship. And can someone tell me, just out of here, like why actually I put approximately x of t minus x of t minus 1? Actually, this will be nice homework for you. Can you actually show to me that y RT, which is s of t over s of t minus 1, and I put a little wiggle, is actually xt minus xt minus 1, where x of t is what? Log of, the natural log of s of t. Yeah. And please provide your answers to Matt or Matthew. Just give it a thought. Okay. Now, total return is the same formula. So you take this, you multiply by minus 1, but now you add this dt. Usually, sometimes, the dt are things like dividend. If a company is paying dividends, a return on a stock is not straightforward as the above formula. But now does actually capital gains and all that. Now, in investment strategies, we really don't care very much of dt over st minus 1. It's actually a small number, and its impact on the P&L is negligible. That's why, in fact, practitioners, quant traders, investment managers, they don't bother with D of t until the 11th hour. They resurrect it. But when they are doing all their calculation, they always use the R of t as in the nominal return rather than the total return. Okay. What's volatility? Volatility, as you now start getting a sense of it, is it measures how stocks, or assets tend to move, their variability. And there are, different ways to measure volatility. Standard deviation is one measure of volatility. So in the financial world, we rarely talk about standard deviation. We talk about volatility. But when we use a standard deviation, we effectively are talking about the historical volatility of the underlying asset. Yeah, you're with me? So now you can go to Yahoo and you can download the historical vol of Amazon. And what you are effectively doing, you are effectively downloading the standard deviation, of, Amazon for either 90 days or 30 days or 60 days. You take the average of that, and they give you that optionality how much. But now there's another concept, which is implied volatility. Implied volatility is also outside the scope of these lecture notes. But for your knowledge base, implied volatility stems from the option market. Yeah? So there are options being traded back and forth. And options are actually a very nonlinear relation with the options. Yeah? What often happens, people have a market, they have a market in options. So we know what the sell price and the buy price of an option. Yeah? Now, thanks to the Black-Scholes equation, which I told you who took the Nobel Prize, these guys, they discovered the most famous equation, which is in finance. It's called the Black-Scholes equation, which is actually a heat equation that actually tell you what is the price of an option in terms of the price of the underlying asset. But that formula has itself a volatility, a standard deviation component. So when you know the price of an option, you can now these days infer backward the volatility, because a priori you don't know what's the volatility. Yeah. And that's called the implied volatility. And when I was working at BPM Paribas, I had an army of quant analysts. All what they do all along is to determine the implied volatility surface, the whole 3-dimension across all the different strikes of options. Why? Because that implied volatility surface, if I plug it in the option formula, guess what I will get? The prices of the calls and the option puts. And therefore, I'll become a market maker. I would know how much to sell option and to buy an option at a given strike level.
So what's the name of that algorithm?
Pardon?
What's the name of that algorithm?
What?
The one that you can inverse to get the implied volatility.
It's called the Bruno-Dupire equation for the implied volatility. And I have my own equation, which I invented to solve that. I will dig it where it is, and I'm more than happy to send it to you. But you have to program it to get those implied volatility. So Bruno-Dupire invented one equation, and I invented another equation generalization of that, which actually infer the implied volatility for various types of options, like vanilla options, cliquets, and all that. I will dig for it, and I think I have a presentation of that. And if you're interested, hopefully I'll be able to send it to you.
Thank you.
Okay. So
is that different than beta for the options? You know how they give the beta, which is like the volatility of the options. Is implied volatility similar to that in some way? Or
similar to what? To beta, you said?
Beta, yeah. Isn't there something that they give you when you look at the options? It's called beta, and it's like if it's over 1, it's very volatile. If it's under 1.
No. So when you are talking about options, I don't know. I mean, there is delta and beta and gamma and all that. These are all what we call the Greeks. So you talk about the Greeks.
Yeah.
Yeah. No, this is different.
Okay.
Those Greeks are what? Are the derivatives, the variations of those options with respect to the price. Okay. So the delta is the first order derivative. Beta is the second order derivative, and then you get gamma and all that. Okay.
Okay. Thank you.
The volatility, implied volatility, is that when you look at the option price formula, it has a sigma inside it. Yeah. And you can actually transform an equation or the equation for a price option to an equation for the implied volatility. And then you can solve for that surface, which I was talking about for David. Okay. What is long-term memory here? So here now we start going into the depth, conceptual depth of stock prices. When you have a price action, the autocorrelation essentially is nothing but it's telling you how memory propagates in that stock price. You agree with me conceptually? If there's a high autocorrelation between time t and time t minus 1, time t minus 2, means that time series is retaining memory. But here's the irony. The more the time series is retaining memory, the more it is non-stationary. The more that it has randomness. It's like a wild beast. Yeah. So how do we tame that beast? How do we actually, so in other words, if I have a random motion, there's autocorrelation, it's very hard to predict in a time series, because now, a time series, which is like if I have a stock price as a function of features, this guy is random all over the place, so it's very hard to predict it. So when you come to models like momentum trading strategies or momentum investment strategies, statistical arbitrage strategies, all these practitioners, whether they are in commodities, fixed income, equity, they are looking for the holy grail of determining and identifying what. Someone can tell me what they're trying to identify. What do they want to capture in order to model this?
The autocorrelation function?
autocorrelation is kind of, it's that beast. They want to tame that because autocorrelation makes the time series non-stationary. So in order for them to predict, what do they need to do? They need to make those time series what?
Stationary.
Absolutely. Absolutely, Don. You're right. So this is the holy grail of investment world. They are looking for time series that they can convert into stationarity. Because once it's stationarity, then they look, okay, does that stationarity have with white noise? Bang, I have now a series that I can predict. Now you are in business, at least in the first part. I can now create a model. Okay. So one of the most powerful techniques, believe it or not, to kind of achieve the stationarity is fractal differentiation. And if you look into most of the academic world, they look at this x of t minus xt to the minus 1 all day long, in the evening, at lunch, at dinner. But we in investment banking and hedge funds, we way gone beyond that equation. The secret sauce is not this, it's something a little bit more subtle, which we call fractal differentiation. So we're going to come to that in a minute. Okay, what is short-term memory? So short-term memory means now, like in a stock return, it is the difference between, a time series at time t and a time t minus 1. And as we've seen before, you look at that, it's pretty much reverting. It's stationary. It doesn't go up and down. It's bound between minus 0.10, 0.15. Okay? And when you do the test that we talked about, which we are going to come in a minute, how to test stationarity, it's going to be bloody stationary. So what we notice, therefore, that differentiation, a simple differentiation, like this guy, renders what? R of t to be stationary. And in this case, it just happened that R of t has constant mean and a STD of 1. Yeah, it's a random noise of 1. Where is it? Here. 0 and 1. Okay. But you might say, oh, Mark Antonio, but this is very noisy. Yeah, returns are very noisy. So how would I actually get juice out of this? Well, you will be able to get juice if you do it correctly. Now, what is the characteristics of the signal? I mean, last time, so this is the return, yeah? We said it's bounded. Many of you, but we said one thing very important. It's what? It's mean reverting. So signals which actually mean reverting, are actually stationary. But it's one thing to be stationary, and it's one thing else whether we can actually now predict the next return. And that's where's the art of building a investment strategy model. But of course, very noisy, as you can see. Why? Because, eventually x of t minus xt of minus 1, you're left with what? You're left with epsilon mu plus sigma times epsilon b. You're left with a mean and a noise term. Now, is this how it works in the real world? Like, is the return always like that? The return is like that, but is this the smartest way to create stationarity? And the answer is no. Okay, so as I say here, be careful. In real life trading, an investment return can actually be non-stationary, which means actually, in essence, this xt minus 1, as much as it looks ideal, in fact, there is a non-constant mu and sigma here. Yeah? So if let's say put beta equals to 1. All right, good. xt minus 1. That's the full formula. That's R of t. R of t is function of mu as a function of time, and a hell of a sigma, hell of a volatility that's function of. So it is anything but stationary. You agree with me? I have random noise. I have all. So then, how can I approximate? How can I actually team that beast to make it more stationary? And that's why I talked about the 3 forms of random walk. The simplest one with constant sigma and mu, the second one with a little bit more volatility on the sigma, and the last one, which is the stochastic volatility model, which we're not going to talk into here. Okay. Any questions so far? Good. So now, how do we test non-stationarity? All right, simple. Take a financial time series like Amazon and split the data 50-50. Take the mean of the first one and take the mean of the second one. Take the variance of the first one, first set of data, and variance. And look at that here. They're way gone crazy. That's the first test that shows you, in fact, that the mean is not constant, nor is the variance or the standard deviation. So that's the first test, okay? That's first. That's not conclusive, but it is sufficient to tell you that your time series is non-stationary. Take the data, split it, and check it out. Then the second test. Now we go into the math of the matter. The
Professor,
yes.
one question here. The 50-50 split is within a continuous of the time series, right? It shouldn't be like let's say like 3 from one and then 1 from the other, and then 2 is like a whole bunch of a time series and then another bunch of another time series, right?
No. It's a one. Yeah, Daniel, sorry. It's one time series. You take Amazon and do it. I would invite you to do this exercise, and maybe Matt is going to show it in his session. But you take that time series and split it whichever way you like. Do it 50-50, and then you see in the first data set, take the mean of the first data set and the variance and the second data set, and you're going to see that they are way away from each other.
Yeah, but for is like if it's a whole year, it should be the first 6 months and then the last 6 months, right? Not like 1 month for one part of the analysis, then the second one to the second part, the third month for the first
The data
for the third, right? It should be a continuum.
Yeah, continuum. Yeah, you take the data, same
Okay.
data. You first.
Okay, thank you.
Split it out the first 6 months and the last 6 months. Yeah, correct.
Okay, thanks.
My pleasure. Okay. So, what are the tests now? We can pop up the volume a little bit and say, okay, for those of you who are doing data science or have done it like Marinda, for example, and some of you, they probably will immediately know what's the null hypothesis theorem. Yeah, Marinda, you've done that, yeah, I presume. Great. So, but here we're not going to go into deep of it. For if you want to know, I have it into the supplement, but you can read about it. The null hypothesis is in fact a test that a time series is not stationary. And usually what you do that, you kind of figure out something called the p-value. We're not going to go to depth of the p-value because we're not trying to do statistics. You can go to Vlad, and Vlad, I'm sure, can give you a very good explanation of the p-value. Is that correct, Vlad? And so as long as the p-value is less than 0.05, means you can reject the H0. The rejection of H0 means the time series is not anymore a non-stationary. It is actually stationary. So it's the not becomes stationary. But if the p-value is greater than 0.5, H0 is not rejected, and therefore the time series is stationary. And I'm sure Matt will show you some exercise in that. But for me, the most powerful test from a practitioner point of view is the augmented Dickey-Fuller, which I also invite you to read about it. It actually measures how it's a measure of the null hypothesis H0. So the augmented Dickey-Fuller test is related to the null hypothesis theorem. Yeah. So it's actually a measure of that, but the number comes out, the test comes out in a different format. It's usually a negative number, which is called the unit root test. The more the number is negative, the more it tells you that the series is stationary. Okay, so we are going to see that in the exercise, hopefully when Matt shows you the lecture notes. And there are different level of confidence: 99% confidence, 95% confidence, 90% confidence, and these corresponds to what we call the 1%, 5%, and 10% critical values. So let's take an example. Let's take Amazon. Again, if we put Amazon financial time series as is, and we try to measure the p-value or try to get the statistics, the summary statistics here that we were talking about, it will show you the p-value 0.999, and it shows you a critical value for the ADF test, 2.42. And then, by the way, this 1%, it's error here. This should be on the other side. I'm sorry. The 1%, 5%, 10%, they should be under the return series, not that one. Just, we will correct that here at the critical value. Now, if you look at the ADF test here, 2.42, and the p-value, what does that tell you about Amazon price series?
It's non-stationary.
Exactly. So I've got two things, the p-value and the ADF. Now let's look at the return series. Let's take now x of t minus x of t minus 1. Oh my God, look at the ADF statistics. It's too good to be true. Minus 21. Usually I'm always looking to minus 3 or minus 4, realistically. And the p-value is pretty much 0. And then look at the ADFs also, the 1%, 5%, 10% is minus 3, minus 2, and minus 5. So obviously, Amazon is not stationary as a time series, but its returns are clearly. And that's a hope. Why? Because now I can say, oh, okay, there is stationarity in the return time series. So now maybe if I want to create a model, perhaps I can try to compare the returns of Amazon to the returns of Google. Yeah. And now I can maybe create a model where I can regress one compared to the other. Here we go. So let's imagine that we have two non-stationary variables, Amazon or Google, or Amazon and Sears, for example. And, we go with the procedure. We create the first time series by taking the log of S1. Don't forget, this is normalized. There's S1 at t over S1 at time t equals 0. Remember, we want x to be dimensionless. The same thing with Google, y. Let's now construct a linear combination between them, which we call S, which is y minus beta times x minus alpha. Yeah? You are going to find under certain condition that actually this S is stationary. You can construct it in such a way, you can determine alpha and y and x and all the Boltzmann bases to be stationary. Now, if x of t and y of t, if S is stationary, then we would say that x and y co-integrate. That's what Engel took the Nobel Prize for. Now you might tell me, Mark Anthony, what the hell, why I should worry about that? Oh, you do, because if you actually take Amazon and Google, and by the mercy of God, you find that they co-integrate, you now have got yourself the first line of a model, a pair trading model between Amazon and Google. Because now you can construct this object S. Remember I told you that traders, you call them pair traders. You know pair traders? Pair traders will do pair trading. Yeah, they construct like 200 pairs, 7 pairs. 20 years ago, they didn't know that. They put them on the spreadsheets. Nah, I like Google. It looks like Amazon. Let's trade them together. That's the science behind it. If Amazon and Google co-integrate, you would be able to construct that difference, which is a mean reverting stationary signal that you can now predict. Hands down, you can predict. So this is the intuition of co-integration. Co-integration, what it means, that the long-term memory of one variable looks very similar to the long-term memory of another. Now, if someone come and ask you, and let's now get other people in the class to answer that. John Griffin, if someone comes tell you, John, what do you think? We are in the tech industry. Do you think Dell and IBM co-integrate? What is going to be your most likely answer?
Yes.
Sorry. Yeah, I would say yes, they do.
Why, John?
Um, Mostly based on just the stocks within a sector tending to track relatively closely.
Exactly. That's a why, in fact, you've got traders who do pair trading intra-sector. Yeah.
Is this
Go from
essentially
sector.
another way of finding correlation between two stocks?
No. It's way better than correlation.
So like an upgrade. So if you both able to identify they both have long-term means that are similar, then
Yes.
you're able to say both of these stocks are going to go in the same direction or vice versa.
Exactly. Well done.
Okay.
This is the point. You see, guys, where now we departed from the concept of correlation to co-integration. It's a far more powerful concept. While we're not going to try to predict Amazon price or Google, but I'm going to create an interrelationship between Amazon, Google, because they happen to co-integrate, they happen to preserve long-term memory in order to actually predict what their difference, the spread. That's what we call the spread between them. Or, in fact, as many practitioners, they call them pair trading. You see here the genesis of pair trading already, straight out of the simple formula, which many people made shitload of money on that just by it. But now, of course, that market's been wiped out a lot, unless you're trading somewhere in inefficient markets in Asia or maybe in Eastern Europe. But here in the United States, pair trading is very, very tough. And you have to do a bit more homework in order to beat the competition. But that's the genesis of it, okay? And still, pair trading, by the way, is a very successful trading strategy. It's just you have to really learn the art of risk management, because sometimes this co-integration breaks down on a short time scale. Okay, so trends and seasonality in trends. So now, okay, when you have a time series that is actually non-stationary, usually it has some bells and whistles into it. It has trend, it has seasonality, it has noise. So what is it? So in fact, there's two ways how to strip those components out, either geometrically, i.e. in a multiplicative pattern, or additively. So you can actually say a time series like in the first graph can be a trend. You can see it, upward trend. It has seasonality, and there is some element of randomness in them. Those three components, in fact, constitute a proper time series. So there's a lot of people who actually try to extract the trend in order to trade. There are a lot of people try to extract that noise, which I would call pretty much the mean reverting aspect of it. Seasonality, I don't think it helps much a lot. Very few people trade unless you are a long-term investment portfolio manager who want to trade seasonality. But usually it's either the trend or the noise, or I'll say the mean reversion, which is what you want to try to predict. And as I'm sure Matt will hopefully show you in the Jupyter notebook that I created, there is in fact an example to show why Amazon is wholly trendy. And there is actually a Python program, which is a Python seasonal decomposition. At my time when I wrote the lecture notes, it has a bug. But I don't know if the bug is there. I'm sure Matt must have either faced it or haven't faced it yet. But I fixed it at that time, and anyway, you would get this kind of split between these three components of. For us, I always look for a trend. I always look for mean reversion. And that's what, for example, does a stock has a mean reverting characteristics around its trend? That's very important. So this is things we look. Like Amazon, yes, is going up, but does it mean revert around the trend? So actually I can create a trading strategy on Amazon itself, but where along its trend line, because the trend line is the non-stationary part. So I take out that non-stationarity, I rescale the trend out, and now I actually have Amazon mean reverting around its trend line. And that is a trading strategy. And there's a lot of people at Credit Suisse, they were playing that game. It's called single stock mean reversion. Yeah? So sometimes you don't need to do them too. As long as you're able to take out the non-stationarity in a clever way and determine that mean reverting line, then you can again try to determine and predict the signal. Okay. So we talked why stationarity is critical. We talked about the the differentiation here. This is what naively academicians use. But I tell you, very few people I know they use that in the real time. I'm one of those who actually essentially, and we didn't publish it at that time, but now it's available, is said, okay, well, this is almost too good to be true, because sometimes we look at the returns and it doesn't satisfy that mu and sigma are not constant. Okay, so, well, how can I improve stationarity? So here we come what we call fractal differentiation. And that's what I really use myself as a practitioner in training models. Yeah, my return formula is not this, it's this. And you say, wow, okay, why here this could matter? Because remember, I have a time series here and it is very non-stationary, and my objective is that I really want to do the minimal effect to make it stationary. I don't want to overkill by assuming mu and sigma is constant when it's not constant. So I want to leave that freedom that mu and sigma might not be constant, but I might allow the inclusion of other components in the time series that bring me that stationarity. Okay, now if you put f equal -1, what do you get? Oh, all those terms drops out. You get r of t is x of t minus x of t. This is our original, beautiful, simple first order random walk. But now we can choose f to be a negative number that's less than -1. So for -1, we get the standard return. But now what we want, and that's what we were doing on the trading desk with my team, is can we find f other than -1 where I can actually produce nice negative augmented Dickey-Fuller tests in the 1%, 5%, 10% critical value to achieve stationarity? And the answer is yes. And here you go. So this is real life here. Yeah, this is academia here. Yeah, this is real life. And this is real life. When I mean real life, this is what we do in real, trading environment. So my pair trading model is based on this, not on this. So here you see that if I take f to be -0.95, and by the way, I leave it to you as an exercise to play around with this f, just here, I'm giving it for this, you'd find, in fact, that now we have more memory retention. Why? Because now -0.5, I have xt -1, but I have xt -2. Remember the autocorrelation? So now I'm retaining some memory here, and so on. So that's, I think, the key. So now I'm retaining memory without sacrificing stationarity. Why? Because when I do the ADF test, it's -3.5, p-value 0.06. I say, great, I'm now off to the races. I've got a fantastic now relation for the return, a mathematical relation for the return, for which now I can put it in a powerful machine learning model to do the prediction for me. Is that clear so far?
Yes.
Very
We have a
good.
quick question in the chat from Daniel. Is fractal differencing a form of Taylor expansion?
Pardon?
Is fractal differencing a form of Taylor expansion?
Yes, indeed. But the key here is to observe that the key finding is not just a Taylor, is that what you want to put on the left-hand side of the equation. And this is where academician practitioners are. Academicians, they're stuck with this. So, okay, return the stock at time t minus the stock at time t minus 1. I've heard it trillions of times. Okay, but is this really correct? This is always correct. It's correct when mu and sigma are constant. But what if mu and sigma are not constant, which is what we see always in the marketplace? I have to be courageous. It's like Einstein's theory. Say, you know what, Newton's theory is wrong, and I'm going to put on the left-hand side what I call really the return. This is my return. If you show this to an academician, they will have hair raised. I don't care, because that's what really works. That's what makes money in out. Not this one. this one. Okay? Now, there's a very good, don't take me wrong, I'm an academician in many hats, I'm a physicist. So there's a very good justification why this actual equation is true and correct. But unfortunately, at my time, we were not allowed to publish these things because it was the secret sauce of trading for pair trading and basket trading. So I have to keep it within the walls of Morgan Stanley, and I'm sure another smart guy at Goldman Sachs figured that out. Another mathematician or physicist or computer scientist or chemist could be, and we're all playing this game. So imagine I'm actually writing model, as Matthew said earlier. My trading model is this, and some guy having a trading model on this. I'm going to beat him all the time with this. I'm going to arbitrage him. Yeah. So that's the game of finance. That's the game of hedge funds and investment banking. It's constantly pushing the envelope to the edge using rigorous mathematics and science. I think this is a good point to stop. And next part, we'll talk about feature engineering. So I think we'll take a break till 7:39, 7:39:40, and we'll come back. Okay? Good. All right, so now we are going to move into feature engineering. And as you can see, we are building that complexity.
Mark Antonio, sorry, before we begin, we have a couple of questions in the chat.
Yes, go ahead.
So Don asks, I might be jumping ahead, but how do RNNs, LSTMs, GRUs perform against the techniques we just talked about?
Look, in the end of the day, and this has been my philosophy for over 2 decades in the investment strategy, you don't want to be in any investment strategy dependent or reliant on one model. Why? Because models have breaking point. So we always advise my team, whether they're scientists, myself, to kind of navigate towards what I would call ensemble learning. So what you talked about is effectively machine learning models, yeah? And ensemble learning, one example is like random forest, yeah, which we are going to come around it in the lectures here. In a sense, it's like a democratic selection between models, because some models can behave well in a specific context, some of them they don't. So let me give you an example. Like decision trees, they actually do well when you have sparse data. You don't have a lot of data, they do well. When you have a lot of data, for example, and it is, what I would call non-symmetrical decision trees, does very well. But if you want to have a lot of data with a lot of depth in observation, of course, neural networks and all that can be a very good instrument. Second thing, so ensemble learning is very, very important. So you want to make sure you don't rely on one model. Second thing, not all machine learning models can deal with financial time series. Yeah, and that's why, in fact, when you are dealing with financial time series, you want to deal with time series that understand the concept of time or understand the concept of order in time. And the closest deep learning model that has that capability is LSTMs. And that's why, in fact, we do use LSTMs in pair trading, but more often to trade the portfolio. But to actually trade in the market, we use a little bit more native, much more simplified version, like a support vector machine model to do the trick. Because why LSTM takes a lot of time to kind of train and to fine tune all that. It can give you, in fact, what the overall portfolio should look like. But from an execution point of view, we can use a proxy for LSTM to trade in the market. So therefore, you cannot rely, there's not like one answer fit all. You just want to make sure that your selection of models is such a way that you want to minimize the reliance of models, that the model you're selecting actually can fit within the scheme of time series.
Yeah. I'll also add that, LSTMs tend to be incredibly data hungry and also highly parameterized, so they can be finicky to work with. And so you might tune an LSTM that works at some point, but to continuously update that model is going to be challenging given the highly parameterized nature of something like an LSTM.
And what about like these new kind of algorithms called auto ML, auto machine learning, that they are kind of retraining every moment for selecting the best model, the best features, and then like retrain one time and time again?
Yeah, because again, do you know why? Do you know why they have to retrain every time and time again? Daniel? Daniel.
I assume that they drift or that the model is not working like by the end of the month or like 2 or 3 months into the model, right?
That's one thing, but there is one important answer to this question. Why do we train? Okay, so now it's good to take. Why, in fact, in financial time series, we sometimes face the prospect of retraining and training the model. It's not like a dog and a cat for CNN.
Okay. Perhaps an investor already saw that same trend, and so the market is already like catching up to that movement prior for me to execute kind of that part of the thing. So I now need to have a new kind of model, a new kind of vision. Is that?
New kind of, forget the model's still the same, but the new kind of what? There's that keyword. New kind of what? Not model. New kind of, say the keyword.
I don't have it right now.
It's in front of you here at the top of your screen. At the first word of the screen.
Daniel. I don't know. Data. I don't know.
Data. Yes, Daniel.
Okay.
Data. This is the key word because data keep updating, keep changing every tick. So those bloody models have to keep training, not overkill, but you have to. That's why financial data is not a dog and a cat. A cat will always look like a cat. Always. Maybe the color will change. But data, financial data, they keep changing and they keep changing in time. That's why you keep retraining your model. And you're right. You have all these super autocorrel machine learning model or state space features models that I used where we actually retrain the model overnight. So when I come in the morning, I have new weights to trade the market. Yes, absolutely. They're static. Your weights don't stay the same. They keep changing. That beta I showed is beta of time. Yeah, go ahead, Matt.
I was just going to say, I mean, with any machine learning process, right? I think Kamaljit said in the chat that AutoML is a platform, which is correct, and it helps the process. You're kind of you're optimizing for a particular goal, and that goal is pattern finding. Essentially, at its core, you're finding increasingly complex patterns. That being said, if the pattern that you're training on, which is all the past data, is different from the pattern that's being produced going forward, that is going to not, it doesn't matter how many ML platform or how many ML models you train or what hyperparameters you choose, you're going to have trouble predicting patterns that just never existed yet. And so that's why it's important to have this ensemble approach where you're constantly looking at different patterns and hedging against different changes in the market. Marina, go ahead.
Yeah, just out of curiosity, so the ensemble method and random forest in particular, so it treats each observation as independent observation, so it doesn't really recognize the temporal pattern, right? So unless if you introduce the left variable to the time series, so how, I'm just like wondering how's that like really efficient in terms of for the prediction, random forest in particular?
Yeah, because, okay, so okay, the random forest is one of those algorithms that, so just the first thing we want to make sure that the time series that we are trying to break is stationary. Yeah. So now we all are happy with that. Okay. Then the second thing is that once it is stationary, then as the time series is ordered, when you are taking different buckets in that order time, it's okay. Okay, because when you're we're going to come to something called backtesting. Yeah. So you provide all the information and you're going to try to predict the next point. But that next point, Marina, is by default is ordered point. So it's okay. So you don't violate that. If you violate it, so where you violate it is that if you try to mix apples with oranges in the way you order sequentially, the data. Now, LSTM has a natural setup for that. Random forest doesn't. Support vector machine doesn't. But you can organize the code in such a way that is actually treating the prediction in an ordered manner, that it respects time order. It's okay. You can use CNN, you can use anything, as long as you respect that order of time.
Thank you.
Yeah, I will add to that. Like random forest, like LSTM has its benefits in that it understands time and can look back through the data for n number of days or n number of time periods, depending on how you set up the model. You can set up random forest, like you said, with lag variables to see data 30 days back. You're going to end up with a ton of features in that model. But in the hypothetical world where a stock is solely predicted by some of the features of a previous day, it's very easy to just look at that previous day's data as a single feature or a set of features and then predict the following day. So what you're losing with random forest is, unless you specifically code it that way, you're not looking back 30 days and understanding that, and for lack of a better term, the model's doesn't have that intuitive understanding of time. But it is able to say, okay, given yesterday's kind of performance, what is today's performance going to look like? And you can set the model up in that way. And as long as you're kind of setting up your training, validation, testing set to not have any mixing where you're predicting today's data based on today's data, it will still it will work to some extent, depending on where the true signal is coming from.
And Marina, we're going to see that when we come to random forest in due course. You'll see it in real example. I'm sure Matt will show us its magic. Okay, so
there are two more questions in the chat if we want to get to those real quick. From Dave Jones, would it be correct in saying that the textbook way of doing things models the system as a Markov process, but the fractal differencing approach models the entire history of the system?
Pretty much so, yeah, correct.
And one more from James. I have a follow-up question about options. Can option pricing be used to predict expected direction and volatility of stock if calls tend to be more expensive than puts or vice versa? That would be an interesting paper.
Yeah, okay. I mean, I don't want to dwell on it. It's outside the scope of this class. We can take it off class, and I'll gonna make a note of that question. I'll answer to James in a separate email.
Sure.
Yeah. So feature engineering. For those of you who did a lot of data science and other branches of science, now you know why features are very important. Now, what do we mean by feature engineering? What do we mean by features? I mean, how many of you in the class understand that concept of features? Please raise your hands in the class and let's count them quickly. How many do we have? 8, good. More? We have 35. I don't speak on. Anyone who understands features, please raise their hand. Quick. Okay. All right, let's say half of the class, pretty much. Some extent, half of the class. So I might as well talk about it. All right, good. So what are features for those who don't know it? Now, when we are trying to actually model a variable like x of t, yeah, remember the stock return. We are going to say, okay, what do I model the stock return with what? Okay, well, are there anything that impact the stock? So this is the thing. Is there something? So let's imagine, let me call the stock the label, the target. This is what I want to predict. Are there any other variables? We call them predictors or features. That's the more fancy, funky way. If you are a statistician, you call them predictors. If you are a machine learner, you call them features, but they're pretty much the same thing. Are there actually features or predictors that impact the behavior of the thing that you want to predict? Okay, so now ask those who don't know about features, if I have a stock, can you name me like key 1 or 2 or 3 features you think can impact the stock? A given stock in the market. give me one thing simple. What could something impact a stock movement in the market? Any stock.
Interest rates.
Interest rates, Sarah? Yeah, good. Well, yeah, I mean, welcome back to the high inflationary world. Interest rates are kind of have indirect way. Great. So this is one variable, one feature. Terrell, I agree with you. One thing which we need to put, so we have the return on the left-hand side, and now we have your interest rate on the right-hand side. Great. Who can give me more features? James.
Like 30 days, like history, basically. Historical last 30-day performance.
Historical, yeah. James' side, he thinks that 30 days historical performance is very important for him. So he added as a feature. Great. Yuvraj.
Reports from like the company or quarterly reports, for instance.
Yeah, but okay, so when you say quarterly, can you be more specific? What number? So I'm saying now we're comparing numbers with numbers. What number you would like to put in?
I guess this is more of like a binary, like is there an increase in earnings? Is there a decrease? You could also say that there's like, you could use like hirings or firings and all that as quantities within the company. For instance, if a company has like a bunch of layoffs, for instance, it may also affect prices.
Yeah, sounds good. Yeah, why not? We can include it. Any more? Something very obvious we can put on the left-hand side, on the right-hand side of the equation. On the left-hand side, we have returns, and we are trying to build the features. We have interest rate. We have, some sentiment scores, for example, binary scores. Any more we can put?
Weather.
Sorry? Sharma.
So I was just kidding. It's Elon Musk tweet. He just tweets the stock will change.
Yeah, all right. Elon Musk tweets, but they have to become in a binary format. Is Elon Musk in good mood or bad mood? Is he up, bearish? So you put them as 1 and 0. You put Elon Musk as a feature, and then put on each day 1 or 0s. Okay. Now, how about the S&P 500, for example? You think S&P 500 could be an important feature, the prices of S&P 500?
Yes.
Very good. Why?
Because of the relationship it will have with your current stock.
Exactly. Good. So this is a feature. So you can put the stock, the index returns itself. So you have a stock return, but you can put the index return, and that is a feature.
And
Good.
other commodities.
Commodities, excellent. Gold prices, foreign exchange. If the stock, for example, has presence in Europe, you can put the euro-dollar exchange as a feature, yeah? And the saga goes on, okay? All right. So in the feature engineering, and this is something we touched maybe a little bit on it, sometimes you have missing points in the data, and we kind of discussed last time, these missing points, sometimes they are genuine missing points, like Christmas, holidays, you don't touch them or you remove them, but sometimes there's actually a missing data. And your data engineer, if you are working and you have a data engineer who works for you and he comes and say, well, look, sir, I don't know what to do here. I have a missing data point. What shall I do? What would be kind of the first thing? You have a data set that you see from Bloomberg or Reuters, and it has missing data points. What do you think the first thing you would do?
Use the median as in imputing the data.
Very good. But even before the median, what's the most basic thing you would do?
Take the loss value.
Even more than that. Very good. I like that. See, now you are going to be prepared. If I'm a portfolio manager and I'm actually interviewing you, I will ask you that question, believe me or not. I say, what would you do if I have some data that has missing points from Bloomberg or Reuters? You're all talking technical. What would be the first thing I would do?
Take the mean.
Go check it at another source.
Yes, Dave, good. So I'll pick up the phone and talk to bloody Bloomberg and Reuters and say, I don't like your data, it's missing data points. Can you give me a new push via API? Before you do any such crazy stuff, you pick up the phone and you talk, or you send an email to your data provider and say, I don't like your data, I'm having missing data points. This is called pragmatism. This is not academic. That's what you do in the real world. Before you start doing funky data science and putting data, pick up the phone or send the email. Good. Once you've done that, I think everything you've said is pretty good. Now, of course, we do something what we call we can take the last observation. Sometimes you have a missing data point and you say, you know what? I think the last observation point is still a good point. I can use that. Yes, you can use that. And that's what called you carry forward the last observation point. One of the techniques, but it's not the only technique. Sometimes you take the average, sometimes you extrapolate, but always call your data provider and let them provide you with a bloody good data, okay? Normalize and standardization, we talked about that. And then we come to the second thing, orthogonality of features. Okay, for those who know features, they understand what's orthogonality of features. For those who you don't, now, what does that mean? When you have all that feature space that we spoke about, yeah, like we're going to see some of them for the stock, the US stocks, you are very likely you're going to find some of those features are actually what? Highly correlated. Yeah, all right. So this is what we call collinearity, if you've done statistics. Yeah, and Vlad you can tell all your colleagues about collinearity. Yeah, so this is when you have features, you have 1,000 of them, and in the mix of that, you have some correlation, some features are collinear. So the model is complex. The dimension of the feature space is big, like 1,000. Sometimes you have 10,000 features. In the case of the US stocks, it's 450. Still big, especially given that you have maybe millions of observations. So you'd like to reduce that collinearity. And that's what we call dimensional reduction. Okay? And there are various techniques for using dimensional reduction. And one famous technique is the principal component analysis. You can use DB-scan. You can use multivariate techniques to reduce dimensionality, but also there are what I would call model-driven techniques to reduce features. So before we talk about the PCA, let's talk what the model can do to reduce the feature space. So when you have some features and they are collinear, you know, then your objective as a data scientist or as a financial analyst or a quantitative analyst is to try to identify which of those features they are highly correlated, i.e. highly collinear, and you want to get rid of them or reduce them in number. One of these regularization that had been used historically and very successfully in regression models are what we call the ridge models, you know, the ridge regression model, Lasso, and ElasticNet. Anybody who have studied this, please raise your hands just to see just how many people have done that before. Okay, good. So about 10 of you. Good. So I mean the rest of you, so therefore it's worth to take you a little bit in that. But I know for those who knows the regularization, at least Vlad, we're going to see it in the context of stocks, which is different. Okay. So if we look at a simple ridge regression, by the way, I'm sorry, in my notes there was the spelling thing. He called it instead of ridge, rigid. I don't know why, but it's not rigid, it's ridge. So sorry for that typo, and I think we can update you with those notes later on. So a multilinear regression model, essentially, it's a relationship between a label, y of t, which here could be the stock return of an asset, and those features we just spoke about, yeah? Among which x of t could be the return of the S&P 500. And beta are that interrelation coefficient. You know, it's the slope, yeah? We call it the slope. It identifies how much x of t can explain y of t. This explanatory part. That's why people like regression models. Because in regression models, you can see it straight in front of you. I'm looking here something that explains something else. X of t explaining y through these coefficients beta. Now, regularization is effectively what is, you know, putting a term that is a square in the beta with a lambda coefficient. Now, why do we have to worry about regularization? The point is that if I take a data set, I can cook you any beta to make that y of t and x of t kind of match each other. And I can, in fact, if they don't match x of t, I can add x of t minus 1, t minus 2. I can actually make it so wide that actually it would fit. Are you going to be excited with this regression model that's actually very fit? Actually, pretty much the opposite. You should feel sad if your model overfits. Why? Because very likely, if it overfits on the data, and remember that, if it overfits on the data that you have used to model this, especially in the world of stocks, and you can do that. A lot of people model that stock returns, pair trading, Amazon versus Google, for example, Amazon versus Sears, and they fit the data and they come so excited. Oh my God, I've got a perfect regression model. This is the time where they should cry, not be happy, because what it means now, if I take another data set, the model is going to look really bad. It's overfitting. Overfitting is one of the most notorious thing in data science and in actually financial modeling. A lot of people get carried away with it, and so you want to control the overfitting. So then we add what I would call here, the loss term, which is lambda time beta I times beta squared to power p. P is what I would call elastic net, because in this case, beta can take a fractal value. When p is equals to 1, i.e. the weights are squared here, and I'm sure some of you have seen this plenty of times where the data science crowd in this class, where did you see beta square in other than regression models? Regularization, where?
L2 and L1.
L2 and L1, yes, but which other machine learning model you use this kind of regularization?
Almost all of them.
Yeah, deep learning, yeah, neural network. You always had regularization because why? Because neural
It
network
normalizes the data.
not because they're all
We're
weights.
going into the next network, and it prevents information falling to the next layer, I should say.
Exactly. So this simple term has its punch, yeah. So not only for regression, So the theme, what I want you to say is the theme and the concept behind it, not really as such the regression model. So that's why we add it, and then you actually fine tune lambda such that you actually penalize the beta. You try to make them as small as possible so that you penalize the features.
Daniel, do you have a question, or is your hand still up from before?
My bad. It was up from the participation that they requested.
No worries, no worries.
Okay, so the whole idea behind this is that now we fit the model to here in such a way we want to minimize. That's the ordinary mean square method, in order to actually increase the value of lambda so that beta is small, their product is still constant, but then you start getting rid of some features, some weights in the series. Okay, we can take the square and we do the lasso regression when p is equal to half, and again you use the lasso regression. This is called the L1. So what we saw here, we call it, for p equals 1, we call it L2 because it's beta square. P equals 1, you take essentially the square root of beta square, so it's beta, we call it L1. L1 lasso is even more brutal because essentially when you try to optimize on the lasso regularization term, you actually force some features down to 0. So you get rid of some of features. And I'm actually a big fan of lasso regression. It's good. It's brutal. It gets rid of some features straight out of the box. You have maybe 400 of them, maybe half of them will be gone by the time lasso is done working. And the same thing applies, of course, in deep learning algorithms.
I have a question, if I may.
Yes, go ahead, please. Yeah.
So you mentioned L1 and L2. So when should we use L1 and when should we use L2?
It is on, to be honest with you, there is an element of preference here. I think if you have some nonlinearity in the data, yeah, because remember, of course, ridge regression is a very good one. But if you have like some sort of a nonlinearity in the data, and you really like in neural network, lasso is very brutal. Why? Because you want to reduce also the dimension of the weights in neural network. You have many thousands of them. You want to get rid of them as much as possible. So lasso would be far more effective in that reduction than I would say the L2, from my experience. Yeah.
I see. Thank you.
I think Don makes a good point in the chat. If you were testing it for model performance, you could do cross-validation to see which one performs better. Would be part of the AutoML framework. If you're looking to do this for feature engineering, I would recommend Lasso, because Lasso will, like Mark Antonio was saying, shrink the coefficients down to 0, and it'll just be easier for you to determine, okay, which features are going to have a marginal impact and which don't. With ridge regression, every feature is going to remain, and so you'd have to come up with some cutoff where, I'll drop features below this beta coefficient. For Lasso, you don't have to do that.
Yeah. Thank you, Matt.
Thank you.
Perfect. Good. So, again, I don't want to kind of keep repeating myself. We've learned now that one of the things that we use in the feature engineering, the transformation of data, the log transform is a very, very good way to the standardization, the normalization, which all show up into the random forest. And these will all actually play a very crucial role into putting the features, of course, remember, why these are important for features engineering. Can someone give me an example? If I have many features, why transforming the data, whether it's a log transformation or standardization or normalization, could be an effective way in the dimension reduction? Anybody can give me an answer to that?
Reduce training time.
Very good, reducing training time. 2, excellent point. Another point. What's the key essence of transforming data? Is to make sure what? That the features are
Same scale.
Same scale. So then we can actually identify collinearity much quicker, and so therefore the deduction process would be far more accurate. So these are the concepts which you need to understand straight away. If a manager is interviewing you and say, "Hey Don, tell me, why do I have to worry about transforming data when I'm dealing with feature reduction?" Straight out say, "Well, because the moment I transform my data, all my features are on the same plateau. I'm comparing apple to apples. I can then identify collinearity between them. Therefore, I can be able to kind of cut the dimensions of those features straight away." Yeah, this is. Or if you have people working for you, they come to you, and this is the answer. You have to kind of make sure that they understand what they're doing, because sometimes people don't understand what they're doing. We talked about fractal difference transform, so this is good. Moving averages, of course, as James mentioned earlier, James gave a good example. When I said, "Okay, can you give me features?" And James said, "Well, I'll take the 30-day moving average." He's right, because James probably is looking at a specific asset class and he's noticing, "What? I noticed this stock return always is above the 30-day moving average, but on a Friday afternoon, just before Christmas, it dips below." So he kind of connects the two and say, this could be a good feature. We're going to learn about that here. So again, these are stocks. Look at that. Well, look at the log transform. So now if you have features of these stocks, like if you are comparing different stocks from the same feature space of the US universe, you are now comparing apples with apples. And that therefore you are sure that your dimensional reduction technique will hopefully be very successful. So that's what so the transformation of data and the feature reduction are interplaying in terms of accuracy and consistency. So never forget that. So now let's come almost to how we can create features. Some of them are given to you, like the US stocks. I'm going to show you in one of the slides coming up. But you can create your own features, like James. Probably James can sit down and look at that and say, "Wow, this is what I need." But some of those come from actually technical trading. So there are people out there, other than myself. See, myself in my career, I've been a quantitative investment, chief investment officer, trader, manager, name it. And therefore, I look at price action and volatility. But I'm not a technical trader. I don't look at the technical chart and say, "Well, the price is above its 20-day average. I'm going to go long. It's below 50 days average and go short." However, those technical indicators those technical data, boy, don't they actually are very important? They are very important. And I would look for them. So don't dismiss them. So let me give you some examples. F0, the closing price over the open. Many traders look at that. The volume. Why do we take the log of the volume? As I said, transforming the data. The volume at time t minus the volume at time t minus 1, 2-day difference. Time t volume minus t minus 50. Maybe like James, you are interested in 50 days prior. I don't know who mentioned the moving average, but the log of the moving average, 5 days, 20 days moving average. Look at that. And these are, by the way, real technical indicators. Huh? I mean, I scrambled them from real life word of traders using them. And I have them in my feature space in my models, by the way. But here I picked them up exclusively for you. Again, the close to the 5 days open, the close to 10 days open, close to now, of course, you will say, well, you know, is there any reason you picked up those? No, this is case by case. So you are a portfolio manager, okay? And the portfolio manager, or the portfolio manager is interviewing you and asking a question. For example, he asked Marina, I'm going to pick up Marina because I know Marina would like to go investment bank. Say, hey, Marina, you know what? I want to consider the close of Amazon to the open 5 days ago, 10 days ago, 20 days ago. Why I should do that? The obvious question Marina is going to say, you know what? I don't know. And that's a good answer. It depends. What are you looking for? Are you looking for long-term trend, short-term trend, or not? You know? So you answer your question within the context of what you're trying to solve. It's not arbitrary. So 5, 10, and 20 here, I picked them up because they are relevant for a specific type of stocks. It could be relevant, for example, for tech stock. But if you look into pharmaceutical, maybe you would look at, instead of 5, 10, and 20, you would look at 30, 60, and 90. That could be more relevant. So that's what I would say, domain expertise becomes very important. It's very important also to understand your underlying asset. And that will help you to understand the features and how to do it. It's not a blind thing. You don't take the set and just blast it. It could help, but look at your specific underlying assets. Let's say you're doing gold. Is the price of gold 5 days ago relevant to 10 days ago to 20 days ago? Not. Is the price of the gold relevant today, 5 days ago, to maybe 30 days ago or 60 days ago? Yeah, because gold is volatile, but it has a trend line around the mean. So that will give you a different type of set of features that you need to focus on. And some people, they do construct those features, as I said, technical traders, and sometimes, you know, from experience, you can build them up in addition. So it's not the only one. We're going to see there's 430 of those that comes. They're called raw fundamental data. This is not raw fundamental data. This I would call technical features. Yeah, technical indicator features. Okay, good. So we take those and now we apply them on a specific stock. And I believe here we apply them on Amazon. I don't know, correct me, Matt. I don't remember which stock, but we do what we call the clustering of features. So this is the beginning of the game here. Okay, out of all these features, which of them they cluster together? Yeah, think also PCA is going to come. Which of them they group together and which of them they don't group together. This dendrogram actually tells you what? That F3 and F7 are actually highly correlated. They're very similar. Okay, while F2 and F8, whoa, far apart. Okay, so let's look at F3 and F7. F3 is the volume difference, or the performance of the volume over 50 days. F7 is the close price T and T minus 50. Now, is there any reason why it picked it up? No, but you know what? The math and the numbers somehow is showing that F3 and F7 are close and F2 and F8 are not. Okay. And then we look at F4 and F6. Same thing. You know, F4, the log of the moving average, and F6, the volume of the moving average. Somehow the data shows that they are close. I mean, this is data speaking. And I think, when Matt will go through the dendrograms, okay, it doesn't matter what the data, but now when you look at that now, holistically, what would you say? Let's suppose you have now 8 features. Do I include all of them in my model? Someone can give me an answer? What do I do now?
You pick the ones that are least correlated, I guess.
Exactly. You pick up the one that are the least correlated. So this is the second lesson now we've learned tonight, is that when we are looking at the feature space, we are reducing the feature space. But what are we reducing? We're reducing collinearity, yeah? We're trying to reduce correlation. We want features that they are the least correlated among each other. That's the key. So here, I want to pick up either F3 or F7, either F9 or F10, or F4 or F6, and so on. And that's now what are called the agglomerate structure of that correlation matrix. And this is hopefully Matt will be able to show you in the code when it comes. The dark blue, of course, means that highly correlated, but then as the light gets darker, those features become less and less correlated, less and less clustered, and this is the one you want to actually pick, yeah? But there is also a trick for how you pick it up, I mean, you have to kind of choose here a line and a threshold from which you want, because of course you could have, imagine here you have hundreds of features. Where do I stop? How many clusters? How many families I need to pick up? So usually there's a line, it's a non-scientific line, but it's an acceptable line, where you draw and say, okay, I want to pick up maybe the most relevant 6 or 7 features, or the most relevant 10 features, okay? So here, let's look at step 1. So let's say set a threshold correlation level of 50%. I want to pick up anything above 50%. So we know F3 and F7 are highly correlated. Why? We measured it's 96% from our algorithm. All right, good. So it's 5 above 50%. I can drop either F3 or F7. Great. Let's look at 4 and F6. Yeah, well, they're highly correlated. Again, 64% above 50. I'm going to drop either F4 or F6. And the same thing with F8 and F8 and F5. And now becomes to you, well, okay, I'm going to drop one of the two. Which one I should drop, F3 or F7? That's where your domain expertise becomes important. And there is no one definite answer. So let's go on back. You, as a investment strategist, you look at F3, it's the volume, and F7 is the close over the open. Which one I should drop? They are highly correlated. Which one I can get rid of? It is your choice whether you think volume is a very important information or not. If you think the volume is pretty much static, like it doesn't change much, means that stock is highly liquid, highly tradable, maybe it's F3 is not. If you see the stock is more volatile, it keeps changing, oh, maybe the close over the open 5 days ago might be more relevant. So you make that decision, and so on. The moral of the game now, that after you have identified, you pick up that threshold of how much correlation is good for you. Here, I put 50%. One of you might say, you know what? I'm actually want to keep everything above, 64%. If I come above 64%, would I keep F5 and F8, or I will drop one of them? An answer. If I choose my threshold to be above 64%, so now I know F3 and F7 is 96%, so I need to drop one of them. F4 and 5, I need to drop one of them. What about F5 and F8? Do I keep them or do I drop one of them?
Keep them.
Exactly. Why? Because correlation 60%. Good. I want you to be thinkers, guys. Thinkers. So now we have a reduced set of correlation. We got really in this case, 1, 2, and 3, and we are left with this set of correlations here, features. That's what's called feature reduction, dimensional reduction, using clustering techniques. Yeah, and the model, by the way, when you do that, it's all model driven, yeah? And here I'm showing you snapshots of the model. The model will pop out for you. You put your threshold, it cooks them and say, bang, 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 bang. Here's all the features you need to left over. Now suddenly, instead of dealing with 100 features, you're dealing with 50. If you're dealing with 50, you're dealing with 10. Nice. Why? Because the less features you have, the more you have explanatory power to the label, the stock return that you're trying to predict, or the pair trading strategy you're trying to predict.
Don wants to know, how big is the feature space typically in practice? And how important is it for model params to be explainable?
Okay, so we said for the US stocks, it's 430 features. If you are considering global stocks, i.e. US, Europe, and Japan, and I think Australia, there is about 3,000 features. Almost 7 times that amount. 3,000 features. So if you are a global firm, like Millennium, or like State Street, or Beliasny Asset Management, and if you are a quant investment officer or a portfolio manager, and you have a trading strategy, quantitative strategy, you are dealing with the 3,000 features. Of course not. You're going to reduce them. And each desk have their own magic number. Like in my case, in the US stock, the 430 features, believe it or not, they go down to about 30. Can you believe that? 30 features which are relevant for short-term investment strategies. And the other remaining 430 are not relevant. So it depends on your time horizon. So the feature space is also a function of the time horizon you are going to trade, your portfolio, and also the backtesting that you are doing. Does that answer your question?
Yes, thank you, Professor.
Thank you. I think we did that already. And I said, of course, PCA is another way we do dimension reduction. And I don't think we're coming close to the hour. So we will do it next time. But essentially, we finished this lecture, which is great. So we are on time, despite the fact and DBScan. DBScan is also another methodology to do dimension reduction. We're not going to cover DBScan here, but I do encourage you to read about it. We're going to focus more on PCA, just the time. We don't have a lot of 7 weeks. Maybe when I will give the course, maybe at some point, but I think you're not going to lose much by it. But I do encourage you to look at DBScan because I use it quite a lot in terms of dimension reduction. Okay.
There's a good question in the chat from Jun Chang. If I consider both F3 and F7 to be very important, despite their high multicollinearity, I prefer not to drop either of them. Are there other methods that we can use to address this, such as adjusting the weights?
Yeah, I mean, look, if you don't want to drop them, fair enough. That's your choice. The only thing you have to deal with a notoriously higher dimension. And if you made a conscious economical reason, financial reason not to drop them, all good. Nobody's saying you must, yeah? But the fact that they are 96 highly correlated means one explains the other straight away. And you can probably write a model how good one can explain the other. You can write a model of one feature against the other. Now, are there other techniques to do dimension reduction? Yes, I said PCA. PCA is a bit different. PCA, what's going to do is going to put F3 and F7 in one component called PC1. So what PCA is going to do is going to remove that redundancy by repackaging features in one vector. So if we go back to this example, when we're going to come and see PCA in a minute, here, this could be PC1, this is PC2, this could be PC3, PC4, yeah? So already we could, in other words, principal component analysis, it uses a techniques of correlation again to repackage features that they have the same properties or characteristics into one vector. And so now you reduce the space into those principal components. And now your principal components are your new feature space. The only problem with principal components is interpretation. What does it mean? What is this new vector that combines F3 and F7? You see what I'm saying? So I think interpretation is going to be very important. Now, so PC is one of them. And then we're going to see, of course, that random forest is a very notoriously very good algorithm, machine learning algorithm in reducing feature space. While you can use it for prediction, you can also use it for essentially classification and redundancy reduction. I think I have somewhere in one of the lectures an example how to do that, and hopefully Matt will be able to show you. So,
do you have a question? Oh, sorry.
Peter.
Yeah, so during the course, when you were talking about fractal return series, you set the number to be negative 0.95.
Yes.
How did you decide that number?
No, you do a search. You see, you can now do a grid between the ADF test and between those negative numbers. And whichever your optimal answer is the one you pick. And I just gave you the example of minus 0.95. So this was not like I just woke up and I decided you try minus 0.9, you try minus 0.8, minus 0.5. You choose a bandwidth or set of numbers and you run and you choose which of this have the lowest p-value and the lowest ADF number, a negative number, yeah? And that's the value of F you pick up.
Thank you.
Welcome. So there's no one
another question.
Yeah.
We've got another question in the chat and then a question from Dave. Question in the chat should be relatively quicker answer. Why does US have fewer features than global stock markets, than the global stocks? Does it have to do with efficient markets and liquidity?
Not really. It's just, I think, in fact, the US have far more features than other markets, just like you have so many global markets. You have Japan, for example. It's about, 500 features. Europe is about like 300. By the time you add them up, they come around to 2,000, 3,000 of them.
Dave, go ahead.
Yeah, US is by large the biggest, actually.
Okay, just a quick, if this is going to take a while, I'll just send you an email later. But so, for example, for the US, we could have these 430 element feature vectors that would take forever to calculate. In addition to the calculation time, would it having that many features also throw off things because there would be like just extra little artifacts of calculation that would appear? Or would having a larger vector be fine as long as you could handle the calculations?
Yeah, I think, look, today's hardware and software is very powerful. So now I think as long as, and we're going to see some of it like later with the PCA, you can actually do two things. Before you put the 430 features in the cooking machine, you can start with the PCA analysis and see, in fact, how many of those features are reduced, And then what you would look inside each PCA and say, which in that PCA vector is the most relevant feature, yeah? So you go down from maybe 430 down with PCA down to, let's say, 250 PCA components, yeah? For example, just by doing pure PCA. And now you have 250 PCAs. Okay, so how do I go from here? Can I explain my 250? Most likely not. So then I would look inside the PCA itself under the microscope, which is the most relevant and have the highest weight, because PAs also give you weights in that PCA, and you can maybe choose the top two or the top one. And now you went down from 30 features to another literally 250 features by approximating the PCA with its highest weighted feature. Or you can put those 430 features straight into a big cooking decision tree random forest, and it will give you probably straight away the top 30 or 40 features that have 95% variance or confidence level, which we are going to see. And that's how you pick them up. So
okay.
you decide.
My point was, like, if you have, like, you can't have too many features. If you keep extras that you really didn't need, it's not going to throw you off.
No, it's not going to throw you off.
Okay, that's what I wanted to check. I just wanted to check.
Exactly. Not going to throw you off. It just makes the interpretation of the model and the results much more cumbersome. That's really I faced it in one of the research papers, like, what is driving what? What is really driving Tesla stock? Is it It's dividend? Is it the investors? Oh my God, is it the debt? My God, this company has a lot of debt. How come the stocks keep going up? Is it because of Musk? He's a handsome little guy? No. So it's something that is driving, Tesla up. Is future expected value? Yes, it is. So then when you come to the features, the 450 features relevant to Tesla, most of them, they drop out of the window. It's so funny when we looked at it. It's just like you are left with 5-6 features which explain Tesla. And one of them is expected future return. And the rest are all irrelevant. So it's not like one fit all. So you can't use the same 430 for every stock. Every stock you go through, you have to run that principal component analysis. You have to do that and see what are and the features that might explain the stocks in the financial industry are not necessarily the same features for the technology industry or for the pharmaceutical. So also industries would have same bunch of features that characterizes that stock. You see what I'm saying? Well, I mean here, one size doesn't fit all.
Okay, so reducing the features also gives you more insight into what's actually happening.
Yes, exactly. It gives you an insight into the characteristics of the underlying sector or industry, which really is important. Yeah.
All right, thanks.
Pleasure. All right, so we talked about that. We're not going to do the linear discrimination analysis, I'm afraid. So we're going to focus on PCA and random forest as our two heroes to do the damage reduction. But I do encourage you to look at the density-based spatial clustering application, the DBScan, which is actually a very powerful technique compared to the dendrograms that we showed you earlier. And maybe that might be something you could apply as Matthew is building the algorithms, is say, okay, you know what? Instead of doing PCA, be courageous and use DBScan or use LDA and compare to your PCA. Be creative. I want you to be creative in this course. Yeah. So be courageous. Matt is showing you the PCA. Go and take DBScan and apply it and say, does DBScan give me the same as a PCA? Yes, no, why? That's what I would encourage you to be proactive about that. Yeah. So create your own journey too in this whole thing. I think we're going to stop here and I'll give the floor to Matt. Matt, you want to give 5-10 minutes break and then you can take from here. It's your call.
Yeah, I think take 5 minutes. We'll meet back at 8:40 for some coding.
Yeah, so we are going to stop here on the PCA and we will finish it hopefully after, 4th of July of the holidays.
And I'll just answer Don's question about, does this mean we don't use poly transforms, interaction effects among the 430 features and just simply feed them to PCA? In this course, we're probably going to be talking about it as if we just feed them to PCA, but I think in practice, there's a variety of things that you can do. Feature engineering is, again, a creative process about understanding the data. You might start with PCA, understand how the features interact, and then test the model on a simple PCA, and if it's doing well, great. You don't need to do something like a poly transform or DBScan. If not, you can build on top of it and work your way up to a more complex model. Typically in model building, my advice is to start simple and work towards more complex and see how the added complexity changes your returns or your model performance. And oftentimes a simpler model will, 1, do better, and 2, be more explainable if something goes wrong.